Hey friends, the Fearless Advisor here. Today I'm going to discuss how diversified your investment portfolio should be. Diversification is a word that is thrown around the investment world like promises in a political campaign. Based on my conversations with many investors, the meaning or purpose of diversification is not widely understood. For example, some investors believe diversification is achieved by having accounts at different firms. Diversification in your investments is a mitigation strategy against unsystematic risk. Unsystematic risk is the potential negative impact on a specific company or industry due to competitors, regulatory changes, management changes, or product recalls. In other words, changes that do not impact the entire economy. At a high level, we can look at categories or asset classes. Some common asset classes include U.S. large companies, U.S. small companies, developed international companies, emerging markets, real estate, and bonds. Now, the first 5 classes I mentioned include having ownership in a company or equity. Owning a stock is having ownership in a company. The last category, bonds, is different, where you are loaning your money to a company or municipality. In return, the company or municipality will pay you interest. The interest you are paid is correlated to the market interest rates and the financial stability of the company or municipality. By owning investments across these different categories or asset classes, an investor can spread the risk of losing their investment while also increasing the value of their investment over time. A popular way to invest across these asset classes is by using mutual funds and exchange-traded funds, or ETFs. These investment vehicles can include hundreds of individual stocks and bonds. These are popular for investors who value diversification and do not want to handpick hundreds of stocks and bonds. Now, back to our question of how diversified your portfolio needs to be. In short, we prefer to build investment portfolios at the household level versus the account level. Portfolios at the account level yield the same asset class investments in every account. This can be confusing for investors who begin comparing which of their accounts are outperforming the others. Since all accounts are your money, why should they compete with one another? Our approach is to set aside the confuse and conquer method and approach all your money as the same portfolio. This allows less investments to be used across all your accounts, which yields shorter statements and less trading fees. Additionally, we can place investments that could have a negative impact on your taxes in your tax-advantaged accounts. In summary, diversification is about minimizing risks specific to an industry or company. Your portfolio can be simplified by investing across all your accounts as if it is one account. You may have all your bond and real estate holdings in your traditional IRA. Your small cap or small company holdings may be in your taxable accounts as they pay little to no dividends. Your portfolio does not have to be complex to be effective. As I have mentioned in other videos, this all begins with your investment policy statement. Once you decide how comfortable you are investing your money to help achieve financial freedom, then you can create your portfolio of investments across all your accounts. If you need assistance or have questions in this area, the team at F5 Financial Planning would be happy to support your family. Feel free to reach out to us at F5 Financial Planning. Thanks for joining us.